Hello, hello. This is Peter trying to get my screen set up better. Hi, everyone. Peter Lemieux messing around with his camera, which is always a joke. You people are all probably too young to remember a funny British comedy guy called Mr. Bean. Just humor me. I know you don't know what I'm talking about. No matter what Mr. Bean was asked to do, he would find a way to mess it up. Sometimes I act just like Mr. Bean, fixing my screen and things like, oh, Carmen, you remember Mr. Bean. But no matter what he had to do, he would go and completely do it incorrectly and mess it all up. Some days that's the way I feel. Welcome, everyone. We're going to have a fun day today, depending on what you call fun, okay? We are not going to have a wine and cheese picnic out in the sun, okay? That's not what we're going to be doing. We are not going to be telling jokes and making each other laugh, and we're not going to be watching videos of cats, okay? That's not what we're going to be doing. I'm going to be talking to you about insurance on your test, vocabulary. Ugh, is there anything more boring than vocabulary? I don't know. I'm going to try to make it interesting because you want to know something? It is critical that you understand the vocabulary that's used on your test. If you don't understand the vocabulary, the questions don't make any sense and neither do the answers. Okay. So we're going to try to break down the vocabulary. If you're going to stay for a while, please take notes of the words you want to remember. Write them down. And if they're really important and you're having trouble with them or something like that, put them on flashcards and read them out loud every day until you get to understanding this. I had a theory once. The concept of insurance, not difficult. You don't need 180 IQ to understand insurance. I mean, basically, folks, this is all it is. People throw money into a pool. And then when someone has a claim, we take money from the pool and pay the claim. So rather than to have to pay your whole claim, you just kick into the pool. And if you happen to be one of the claimants, there's money for you. I just explained insurance. I think everybody gets that. So why is the test so daggum difficult? It's the language. These words they use they're not words we use sitting around watching a ball game with friends and having a couple beers. We don't talk about hazards and perils. Okay. We don't talk about indemnity. So we're going to try to tear into that. So if you can stay with me for a while and take some notes, great. If you can't, I'm glad to do whatever I can to help you guys pass this test. So now let me advance my slide. This is my commercial. I do this a couple times. If you go to YouTube, Insurance Exam Queen, and click on join, there are actually two wonderful offers there for you. If you think that the gold and bronze packages and silver packages may be a little financially steep for you, although I'm going to tell you something, they're the best buy on the internet. You can't get more information for dollars than those packages that Melissa offers. However, we do offer a couple of subscriptions where you only pay for a month. You can either get Melissa's whole property and casualty videos or all of my life and health videos, one or the other, for about $25 to $30 a month. And a month should be plenty of time for you to get it done. So if you can go to YouTube, Insurance Exam Clean, click on join. I think there's a wonderful financial opportunity for you to get videos to help you understand this. That's my commercial. First vocabulary word, fundamental to understanding why people get insurance. We all live with risk. And most risk, we just take care of ourselves, right? I mean, what's a risk? I got a risk that my tea will get cold during the class. If it gets cold, no big deal. I'm not going to buy insurance to keep it hot, right? So a lot of our risks are so incidental, we don't just live with them. It's called life, right? Some risks are so large that it just doesn't make any sense to live with them. If you own a $200,000 house and a storm comes through, uh, or a fire breaks out, and you've got damage, and to rebuild it might cost $150,000. Most of us don't have that in our cookie jar. So um, the correct or the prudent thing to do would to take that risk of my house burning down and give it to an insurance company. Transferring the risk is insurance. A risk is not a claim. It's just the potential of a claim. But risk is out there for all of us. Okay. So two types of risk we have to know: pure and speculative. Um, I don't know if the next slide explains them. Oh, yeah, there we go. Pure risk is the loss or nothing. There's no chance of a gain. So, in other words, you either lose it, or if you transferred the risk in a pure risk, you can get it restored, but no gain, right? So what am I talking about? You own a 2018 Camry and it gets totaled. You're not going to get enough money to go out and buy a Ferrari. Okay. You're going to get enough money to go and buy a used Camry. That is restoring you to where you are. That's what makes something a pure risk. Now, is like gambling. Imagine, although some of you may have done this, okay, you get in line and you spend $10 on one of those mega lottery tickets. You don't want to get your $10 back. You don't want a pure risk, right? You want the opportunity to make so much money that maybe you'll never have to work again. Okay. That's a speculative risk. It's win or lose. There's no restoring. Okay. And that is nothing that's insurable. The only risk that's insurable is the pure risk, right? Some words here, right? Risk, pure, speculative. Handling risk. Occasionally, this question shows up on the test, and I'm going to give credit where credit is due. The insurance exam queen, Melissa, came up with this acronym called STAR. She took the 5 ways people can handle risk and created the word STAR with 2 R's. So, how can I do it? The S stands for share. I can share the risk. I am not handy at all. I'm Mr. Bean, okay? And so if something breaks or needs fixing around the house, I have a son-in-law who's very talented at that, and he has tools that I don't have. So he told me, look, if something happens, I'll come on over. If we need to buy something, you can pay for the parts and you can help me. What I do is I hand him the tools, right? I cheer for him. I bring him a beer or something like that. That's my participation. But that's sharing the risk. If something happens, we'll get it done with his help. Okay. I can transfer the risk. This is insurance, my friends. I have insurance that if damage is done, that's covered by the insurance company, they'll fix it. Okay. I can avoid the risk. Now, to avoid the risk, I really am going to use the example of an auto. I have an auto that I treasure. I do not want that auto damaged. So I do what Jay Leno, I don't know if you guys know who Jay Leno is. He owns a garage full of collector cars. He doesn't drive them. He just keeps them. My own son-in-law, another son-in-law, actually not a son-in-law, he's my brother-in-law. He just bought a Corvette that he keeps in a bag and air filters it in so it gets no dust on it. He's not going to drive it. Okay. He's avoiding the risk of getting it damaged. All right. I can retain the risk. Retain the risk says if something happens, I'll just fix it myself. I think, truth be known, most of our risk we retain. Okay. Uh, so I have a scale, just happened this morning, a scale in the kitchen. I step on it. Oh, no, not again. But nothing comes on. My scale's not working. I'll fix it. I got batteries. I put them in. Okay, that's retaining the risk. Something happens, I just fix it myself. Put batteries in. And finally, I can reduce the risk. So you reduce the risk by using things less, like driving less, or only driving when there's very little traffic. I still have the risk of getting in an accident, but I reduce it. Okay. So STAR stands for 5 ways of handling risk: sharing, transferring, avoiding, retaining, and reducing. Now, I don't think that you need to memorize that, because if you get a question on it, it'll be pretty self-evident. They say the following are ways to handle a risk. Which one is wrong? And they'll throw in this one: ignore it. That's not wise. You got to deal with it one way or another. Okay. So ignoring it, I would have a scale that doesn't work. Okay. Because I just ignore it. I don't care. So I'd have an object in my bathroom that doesn't function at all. Ignoring it's not good. It's not one of the 5. All right. Well, that was a long-winded way to explain it. Now, insurance is transferring this risk. We don't transfer all our risks, but risks that are important to us or perhaps a lot of money to replace. We want to transfer them. That's the purchasing of insurance. Okay. So, a question, and I want you to put the answer in the chat box. Okay. Buying a lottery ticket, is that A, pure risk, B, an investment, C, a speculative risk, or D, retirement planning? Which is the correct answer for this question? Put the letter in the chat box. So we have one person, 2 people who voted. Good. I don't ever criticize or throw someone out for missing a question, and we're all studying here. Okay. I got CA, AC. 2 A's, 2 C's. Somebody want to break the tie? Thank you, Sherry. C is actually the correct answer. Okay. We buy a lottery ticket. That is a speculative risk. It's win or lose. No restoring you to where you were. Gambling is always a speculative risk. Question: how to handle a risk except, I already told you this answer. I mean, do you want me to just move on, or somebody want to get brownie points and get it correct on the chat box? Everyone's a way to handle a risk except, and the choir says ignore. Ignore would be correct. You don't ignore it. Next, we want to talk about the concept of the law of large numbers. It says the more data you have to look at it, the more predictable the losses will be. If you've ever taken a course on statistics or any kind of scientific experimentation or something, if you don't have large numbers, your conclusion's invalid. Let's say that there's 20 of us together today, and I got all your names and addresses, and 12 months from now, I contacted you, and I find out none of you died. Would it be accurate to say if you take Peter's course, you will not die? That's the problem with the law of, not having enough numbers, okay? In that case, it wasn't the data of people is not, there's no old people or whatever, but 20 is not enough to draw a conclusion. Okay, so you have to test it over large numbers. Why is that important to insurance? And insurance companies make rates. They have to predict what kind of claims they're going to get. That prediction is based on a lot of data. They actually know in the county where you live in How many heart attacks will occur in 2025? Now, are they going to get it correct to the exact one? No, but they're going to be close because they've been watching this for years. Okay. Now, with that information, it's easier to come up with a premium that allow them to pay the claims. That's the importance of large numbers. Now we have a new word, exposure. Exposure is a unit of measurement to determine rates for an insured based on how risky they are. There's a saying right now, my son uses it all the time. It is what it is. Okay. Why argue about it? Why talk about it? It just is what it is. That means he doesn't want to listen to me. Okay. But exposure kind of is like that. When you present yourself to insurance, you can't change who you are. You are a certain age. You have a certain health. You are a certain height and weight. You have a certain medical background. And what the insurance company can do is they look at the exposure you present to them and they put you in with similar people to give you a rate class. Okay, so if an insurance company and auto insurance wanted to get a rate for seniors, and you present, and they start a senior at 65, and you present to them that you're over 65, they're going to put you in the senior rate class. Okay, so that's all exposure is. You are who you are, and you present a certain risk to the insurance company, and they're going to put you in the class of risk that you should belong to. Hazard. Hazards increase the chance of a risk. If I go to an insurance company, I don't have any hazards. I'm going to be like, oh, wow, this is fantastic. This person is normal. So they're going to put them in with the standard people, right? Maybe preferred because they don't have any hazards. But the insurance company has to consider 3 different hazards, and you need to learn what the hazards are. Number 1 is physical. If you're studying life insurance, physical would be your health, your height, your weight, your cholesterol, your health history, right? That's physical. Okay. And property and casualty. Physical could be I have a house with cracks in the foundation or a dead tree in the front yard. Those are physical hazards that could increase the possibility of a claim, right? So those are physical hazards. They are what they are. And the insurance company has to determine, number 1, are they even going to cover you? And if so, at what rate based on the physical hazard? Now we're going to get into the last 2, which often confuse people because one is moral and the other is morale. There's a real simple way to get this right every time. A moral hazard, lying on purpose, like lying on an insurance application. After the word moral, please write the word dishonest. This person has no problem lying. Okay, why is that a problem? Well, they could lie on the application, right? It's not out of the question. They could put in a bogus fake claim and lie about what happened. Someone who is just has no problem telling a lie presents a moral hazard to the insurance company. Now, do we always know that? No, but maybe in the background we can see that something they've done in the past would indicate that this may be a moral hazard. Please don't get me wrong. All hazards are not uninsurable. Just because you got a tree in the front yard doesn't mean you can't get insurance. Just because you got arrested 10 years ago for running a scam on the public and you did your time and you paid your dues, that doesn't mean we won't insure you. But we're certainly going to look at you and say, we may have to charge extra because this person has a history of being dishonest. But that's a moral hazard. When we get to morale hazard, what you want to write there is careless. Mr. Bean, careless. Okay. What's the problem with careless people? They do dumb things that cause losses, right? They don't lock the house when they leave, right? They leave their work computer on the front seat of an unlocked car. They don't take care of things. including themselves. They're careless and they have accidents, and sometimes we're insuring those accidents. So what we have is physical, moral, and morale. Moral's dishonest, morale is careless. So it would be a way to remember those. Moral is one of, I think, the most important words in insurance. Those of you who are studying property and casualty will understand this more than people doing life and health. Because in property and casualty, the difference between a DP1, a DP2, and a DP3 are the perils covered. I mean, you have to know which perils are covered by which plan. What the heck is a peril? A peril is that thing which causes the loss. Like it could be fire, hail, lightning, explosion, theft. And then you find out some perils aren't covered in property and casualty, like flood. Okay, but peril causes the loss. In life insurance, the peril covered is death. In health insurance, it's accident and sickness. There is no insurance policy that covers all perils. So Stephen Caruso is in our class. We're going to imagine Stephen Caruso has $100,000 of life insurance and he breaks his arm. He puts in a claim on his life insurance policy. How much money are they going to pay Stephen? The answer is a big flat zero. Stephen's still alive. The only peril covered on that policy is death. Okay, he needed another kind of policy that would cover the broken arm. So peril is the cause of the loss. Very, very important when we look at insurance. So what the heck is a loss? Be careful. Some people say, everybody knows what a loss is. Yeah, maybe. Probably do. But sometimes you got to be able to say it in insurance words. And the insurance words are a reduction or disappearance of value. That's easy when my car gets wrecked. It's not worth what it was before the wreck. But what about life insurance? How is it a reduction in value? God bless you, Steve. We don't want this to happen, but Stephen passes away. How is that a reduction in value? Well, Stephen was worth something to people. If he had a job, he made money, shared the money with people he loves, that's gone. Okay. Even if he didn't have job, there's relationships, very close relationships like family or marriage or something like that, that disappears when Stephen goes to sing in the heavenly choir. Okay. That's a loss. So a loss is a reduction or disappearance of value. Indemnity. Got to know indemnity. Indemnity is the core of insurance because insurance restores you. It doesn't give you a profit. I already gave you the example. You can't get a Ferrari, okay? But that's what indemnity means. Our intent is to restore you to your previous financial condition. And it's really, really important because without it, insurance becomes like gambling, okay? I don't like the people you hang out with. I think you might die. I'm going to put $2 million on your life for the next 2 months. First of all, I can't do that, but there's something called insurable interest. But I'm just saying, indemnity is not to make a profit. Indemnity is to restore. Our word for that is indemnity. All right, question time. Increases the probability of a loss. A, B, C, or D? If this were a live class, well, it is a live class. I don't think any of us are dead. But anyways, if this was a class where we were all in the same room, I could have prizes. Like maybe you'd get a Tootsie Roll for getting something right. I'm trusting most people know what a Tootsie Roll is, but you never know today. You never know today. All right, Let's see what the right answer is instead of me babbling. Increasing the probability of a loss is a hazard. Any golfers? If any of you have ever tried this ridiculous game of golf, they have hazards in golf. A sand trap, water. What does that do? It increases the possibility you're going to have a crummy score, because when you land in a hazard, it's a problem. It increases the probability of a loss. The only reason I complain about golf is because I stink at it. Okay, so you probably figured that out. All right, question. The cause of loss. Which of those answers looks correct? Well, most of you are going with A, and that would be correct. Peril is the cause of the loss. The question. A convicted arsonist. We're all over the barn on this one. A lot of disagreements. Most people, it appears to me, unscientifically, are going with A, which would be wrong. A morale hazard, A, is careless, but an arsonist is dishonest, which puts them in the B category. So please, a lot of you missed that. Write down moral, dishonest, morale, careless. Okay, I don't want you to miss that on the test. That's like an easy question because it's so to learn it. Just write it down and get it clear. Don't walk into the test confused on this one. There's enough difficult questions. This one you should just have in the bank. Now we're going to talk about more vocabulary. Adverse selection. The insurer covers more people of high risk, making the possibility of higher claims more likely. Let's just make an assumption. It's just you and me having a cup of coffee talking about the ball scores. Let's assume that the drivers with the highest incident of responsible accidents, by responsible I mean they're responsible for it, are drivers between the age of 16 and 19 who happen to be male. I don't know if that's true, but it's probably not the worst thing to believe in. 16 to 19-year-old males. So an insurance company says, hey, we got to insure some of these dudes. We can't not insure them. But we have calculated our rates that we will only insure 5% of our insureds will be in that category. And the insurance company makes a mistake. Mistake, I mean, is they charge very little rate for these people, which does what? It's like honey for a bear. All the young men are going to be looking to this policy because it's the cheapest, right? Now you look at your books and you have 25% of your insureds between 16 and 19-year-old men. That is an example of adverse selection. You are bound to have more claims than the average because you have adverse selection. We can have adverse selection by having too many people who smoke on the life insurance or are overweight on prescription medications. We can insure that, okay? We want it to be a fair percentage like the normal population. When it becomes a large part of our business, it's problematic and it's adverse selection. Okay, that's the words, adverse selection. The insurance company protects themselves from adverse selection by doing something, not my next slide, but does anybody know how an insurance company protects themselves from adverse selection? It's a one word. And it starts with a U. Useless. No. One word to protect us from adverse selection. I know somebody in here knows this. You're just being shy. And I'm running out of time. The word is underwriting. Okay? Sherry, underwriting. We take an application and we give it to the insurance company to underwrite it, to make sure they're not taking too much adverse selection. Oh, that's what all that stuff means. Yeah, it's pretty important, actually, pretty important. Now there's something else. No, it's something called a certificate of authority. It allows insurers to sell in the state, making them admitted and authorized. All of us here, except me, are trying to get a license from the state. That license will allow us to sell insurance. Okay? We get a license from the state. Insurance companies to sell in the state must also get permission from the state, but they don't call it a license. They call it a certificate of authority. So if Swamp Life of Georgia wants to sell in your state, they would go to your state insurance department and they would apply for a certificate of authority. And the state insurance department would check them all out. They'd look at all their finances, they'd look at the policies, they'd look at everything. And if there's something they didn't like, they would not give it to them. But if they say, yeah, this is okay, you can sell in our state, they then grant them not a license, a certificate of authority. Now, the words you want to connect to that are admitted and authorized. That means they're admitted and authorized to sell in that state. Okay? Admitted and authorized are synonyms. They mean the exact same thing. Okay? Now, I don't know how to say your name. Elisheva, that does not make them domestic. Okay? They are only domestic in the state of origin. Swamp Life of Georgia probably incorporated in Georgia and would only be domestic in Georgia. Getting a certificate of authority in Florida would not make them domestic in Florida. Well, what's the word for that? It would be foreign, right? But anyways, just because you get a certificate of authority does not change your state of origin. Everybody clear on that? Insurable interest. You cannot insure property or a person unless you have insurable interest. So, Elisheva, mispronounced, I'm sure. I'm going to pick on you. I cannot insure your car. Why? I can afford to insure your car because if your car gets wrecked, it doesn't cost me a penny. I have no insurable interest in your car. I can insure my car. My kids who I'm responsible for, I can insure their cars, right? To have an insurable interest, a loss could cost me money. If that doesn't exist, I cannot insure that. Fair enough? Let me just take it one more example. Elisheva sells her car today, and tomorrow it gets wrecked. She gets nothing because she has no insurable interest in that car anymore. All right? So interest has to be understood. Now, what is insurable interest? You, your spouse, relatives within reason. What I mean by that is I have a cousin I haven't seen in 40 years. I don't have insurable interest in that cousin. Okay. But people who financially dependent, right? A business partner, important employees who make me money, right? Because of their work, someone who owes me money and their death would mean I can't get repaid. Any property that I own, those are all legitimate insurable interests. Now, one other thing I want clear to you folks, because there's a little difference between property casualty and life and health. I don't know which you're studying for. In property and casualty, this makes so much sense. You must have insurable interest at the time of the claim. Elisheva had insurable interest when she owned the car. As soon as she sold it, she lost insurable interest and she can't get payment. Okay. Now, what's crazy, if any of you are studying for life insurance, in life insurance, you only need to have insurable interest at the date of the application, which is wacko, but that's the rules. Why is it wacko, Peter? Well, I don't mean to shock you folks with this piece of information, but not all marriages last forever. I know that's shattering your dreams. So I insure my spouse. My spouse runs off with the pool boy, but I own her policy. If I don't cash in that policy and she dies, I get paid because I only needed insurable interest at the time of application, which is why if you stay up late and you watch those murder shows, it's always the husband or boyfriend who bought life insurance before she was found murdered, okay? Only needs exist at the time of application. That's life insurance. Property and casualty makes more sense. You need to have insurable interest at the time of the claim. Are we okay? Somebody give me a thumbs up. I mean, I talk, but I don't know if I'm always making sense. I have 5 kids who'll tell you I don't make any sense. No? Thank you, Will. Okay. Now we're going to learn the difference between a stock company and a mutual company. Excuse me. Tea. It's not as hot as when I started. Stock company is owned by shareholders. They issue non-participating policies. Dividends are taxed. Example. Aetna is a stock company. You don't need to know which companies are stock, okay? Aetna is owned by stockholders. You could own Aetna stock right now and not know it if you're in a 401k or you own a mutual fund, and they could buy some insurance stock and you wouldn't even be aware you're in there. But Aetna is owned by the people who own stock in it. I can go out and buy an Aetna policy for my home, okay? Or a renter's policy or whatever. When I do that, I am buying a non-participating policy, meaning I don't participate in what? In the profits of the company, because I don't own any stock. Okay, the profits go to the stockholders, not the policyholders. If the insurance company like Aetna has profits and they distribute dividends, they don't go to the policyholders. They go to the owners who are the stockholders, and dividends in stock are always taxable. It's an extra income. Okay? That's what we know about stock companies. Now, we want to move on and take a look at a mutual company. I promise you, every single one of you, you're going to get a question on stock and mutual. It's on every single test. So here's the thing. If you know it's going to be on the test, it's not that hard to learn, and you miss it, shame on you, right? I mean, just learn it. It's not that difficult. In a mutual company, let's take a company with mutual in its name, Mutual of Omaha. It's owned by the policyholders. I don't know how you want to remember that. Mutual to me is we kind of have an understanding, an agreement between each other. I own a policy with Mutual of Omaha, and it's participating policy, which means if they have dividends, they give them to the policyholders. Okay? There are no stockholders. The policy owners own the company. And those dividends, interestingly enough, are not taxed. The other ones are taxed. These are not. If you care to know why this is not on the test, the IRS looks at that as you paid too much in your premium and they're giving you your own money back. but the dividend in a mutual company is not taxed. So what do I need to remember? Stockholders, non-participating, dividends taxed. 3 things. Mutual, owned by policyholders, participating policies, dividends are untaxed. 6 items that could be on your test. I don't know if there's any others. Learn them, get them right. Alicia says it definitely was on her exam. Okay. Now, the other thing is, it's not on my slides. There are 4 other insurance companies that will show up on your test, but usually only one of them, and it changes around per test. So we don't usually include them in our slides because we don't want to overburden you. Learn stock and mutual. Those other guys, the fraternal, risk assessment, and Lloyd's, just have a rough idea, but learn these 2 cold because these are going to be on your test. Okay? Advice from your Uncle Peter. What's reinsurance? It's when an insurance company indemnifies another company. It's insurance companies insuring insurance companies. Wow. I used to say in the 60s, far out, man. So what we're talking about is an insurance company gets a policy and it's got a large coverage. I'll make up a number. Jeff Bezos buys a $1 billion life insurance policy. It's going to cost him a lot of money, but what does he care? His money is nothing to him. He pays for that. The insurance company says, this is great. That was a great sale. But someday, Jeff Bezos is going to die. And we got to come up with $1 billion on one claim. So what I want to do is I want to spread that risk around. So we'll make the example simple. I go to another insurance company. Jeff does not know this, and ask him to reinsure this. Let's make it simple. You take half the claim and I'll take half the claim. I'll give you half the premium. Okay. And then we'll go along some date in the future. Jeff dies. You give me 500 million. We'll kick in 500 million. Jeff's widow gets a check for $1 billion. Jeff sees none of this. Okay. He buys from company X, pays company X, dies. His widow gets a check from company X. But behind the scenes, they've split up that claim so they don't have $1 billion going out on one claim. Spreading the risk. The insured does not know anything about it. It is 100% legal. It's just called reinsurance. That's all it is. Insurance companies insuring insurance companies. Okay, now we're going to go back to what we were talking about before. The difference between domestic, foreign, and alien. Domestic is an insurer, their insurer is in the state they incorporated and selling. So we got this made up company, Swamp Life of Georgia, and they incorporate in Georgia. Anybody in Georgia who buys their policy is buying from a domestic company. But if they make a sale in Florida, because they got a certificate of authority, right? Those people are buying from a foreign company because Swamp Life of Georgia is not incorporated in Florida. They're allowed to sell in Florida, but their corporation is only in one state. So they would be foreign in Florida. If you buy insurance from a company from another country, you buy a policy from Sun Life of Canada, okay? They get approved to sell in your state. You buy from them, you're buying from an alien company. So we must learn domestic, foreign, and alien. This is one of these things that it's easy. So you should learn it. And don't be confused about it because these are the easy points. There are some questions that come up that are complicated and more difficult. So we want to get all the easy ones, we want to get 100% on and get as many points as possible. Time for a commercial. As I've said in previous classes, we have imagine a bunch of dancing hot dogs, wonderful choral music, and they're telling you, you want a good deal on videos? Go to YouTube, Insurance Exam Clean, click on join. You can get all of Melissa's videos for like $32. It's for only 1 month. Or you can get all the life and health videos from Peter, for like $26 because I'm not the queen. Okay. But it's a great deal. If it can help, please know about it. Okay. That's my question. All right. Loves the questions. Insurance company owned by policyholders. Which of these companies is owned by policyholders? I'm not trying to put anybody down, but my friends, this is one of the easiest questions you'll get on the test. So make sure you learn it. It may not be easy today if you didn't know it, but I'm telling you, for the test, it should be. So the answer is, of course, mutual, owned by policyholders. I want to talk now about the law of agency. How am I going to remember this? Agency is a place where you might work. You might work at an agency representing a lot of companies or one company or whatever. But the agency is kind of home base where agents hang their hats sometimes, unless they're an independent agent. But the law of agency puts all the pressure and responsibility on the insurance company. That's what insurer means. If we as agents distribute or say things that are not accurate, the insurance company can be held liable because they hired and trained us. Okay? Which means when you get a contract with an insurance company, they're going to tell you only use our approved materials because we know they're factually true, and explain them correctly, because they know if material goes out that's inaccurate, they could be held responsible. All right. So ultimately, the knowledge we give is expected to be knowledge we got from the insurance company. That's all law of agency is about. Now, as agents, once again, I got 3 things. I had 3 hazards, right? Domestic, foreign, and alien is 3. There's lots of things we got to learn 3s of. This is an agent's authority, and you can get asked about 3. And my friends, this is the easiest one to remember. Express authority is written in your contract. You can do this and you can't do that. And yet, I say to myself, everyone gets a question on express authority, should be thankful because that's the easiest one to understand. And yet, people missed it. I said, what's going on here? The question was, who grants you that authority? In other words, who do you have a contract with? Make no mistake, your contract is with an insurance company. They give you permission to sell their policies and a contract. It is not with the insurance department. The insurance department just gives you a license, but they don't give you a contract. Contracts come from insurance companies. Understanding that you should get express authority correct every single time. Now we're going to get 2 that are hard to understand because they're not in your contract. They're going to be implied and apparent. Now, there's lots of ways to explain this, but I'm going to do the way that makes sense to me. Let's start with eyeglasses, okay? In implied authority, the eyeglasses go on the insurance company. What would the insurance company expect of me? And so I make up this example. You're working in an office, there's lots of agents there, and somebody comes in to pay their premium, but their agent's not there, and you're waiting on them. What am I supposed to do? This isn't my client. Can I take their money, or do I tell them they have to come back later? What would the insurance company expect me to do? Now, I don't know how you're thinking about this, but insurance companies want the policyholders taken care of. they would expect you to take the money, give them a receipt, and then give that money to the agent promptly. They wouldn't want you to tell the people, tough, your policy's going to lapse because I can't take your money. Okay. Who's making the call? The insurance company. From the eyes of the insurance company, it's implied that you can take that money. It may not be in the contract, but it's rendering good service. Okay. Now let's look at the last of the three, and that's apparent. Apparent comes from the word appear. It looks like. So now those eyeglasses are not from the insurance company, they're on the eyes of the customer. In the eyes of the customer, what does it look like to them? So if you show up with business cards with Swamp Life, letterhead, stationery, they are going to believe that everything you're telling them comes from Swamp Life of Georgia because it looks like it. Okay. Now, here's where we can get on a slippery slope. When we have crumb bums, crooks in the business, and they take Swamp Life stationery and they type stuff on the policy that's not true. They give it to the policyholder. The policyholder has every right to expect that that was the truth because of apparent authority. It sure appears that you have the right to do that. Sometimes agents can do things with people because of their business cards they're not really supposed to be doing. A simple example is to tell someone they're insured when they have to go through underwriting first. And properly, you should say to them, you won't be insured until you're approved, but you just say, don't worry about it. You gave me some money, you're covered today. Depending on the type of policy you're selling, that could be true or false. But it appears to the policyholder that what you say is true. So you got to learn express is in a contract, right? That should be simple. Implied is from the view of the insurance company, and apparent is from the view of the client. Those are the two that will give you perhaps challenging questions, but try to remember that way. See the word fiduciary on the test. Fiduciary really comes from the fact that you are handling other people's money, and it's a matter of trust. When they give you the money, they trust that you will put it where they tell you to put it. That's a fiduciary responsibility. It's handling other people's money in the manner that they expect it to be done. Standard of fiduciary is trust. They trust that you're going to do the right thing with their money. Okay. Okay, question. Authority written in the contract. Which is the right answer? A is the correct answer. Express authority is written in the contract. Another question, showing a business card and stationery. Ooh, which one's that? Well, let's see what the answer is. That is apparent, or letter B. It looks like, from the policyholder's point of view, because you got that stationery, that what you're saying comes from the insurance company. It looks like it. Give you another wild example about a parent. It's crazy. You get stopped by a policeman when you're driving. Policeman obviously has authority. They got the car, the lights, the uniform, the badge, okay? They got authority. Do they have the authority to do whatever they feel like? No. Their authority is limited. But it appears to somebody who doesn't know that whatever they tell me, I got to do. Okay, that's apparent authority because they look like they can do whatever they want. That's apparent authority. It can be misused, and they could do the right things. But I'm just trying to make an example. Now, I'm going to talk about a contract. A life insurance policy is a legal contract. And just like any contract, to be legal, it requires 4 elements. These are on your test. You want to get these down as cold as possible. Did I say that right? You want to learn them as well as possible. The 4 elements are agreement, consideration, competent parties, and legal purpose. So let's start at the beginning. Agreement has 2 parts to it, an offer and an acceptance. If you only have an offer, there's no agreement. Okay? The offer is our client submits an application. They want to buy a policy. There's no agreement till the insurance company looks at it and accepts it. Then you have agreement. Okay? Now, the second part, by the way, this does not give you insurance because we have to get the second part also. Consideration, okay, this offer is you submit an application, acceptance, the insurance company says, thumbs up, I'll do it. Now, consideration also has 2 parts. The insured has a responsibility and the insurance company has a responsibility, or there's no insurance. The insured submits an application, hopefully with truthful information in it, and pays the premium. My friends, that's key. No premium, no coverage. Okay? When I learned consideration, I made in my brain, I had a dollar sign. Consideration requires payment of premium from the insured. Now, from the insurance companies, they make a promise to pay a claim. They do that with a policy that says you are insured for these perils, and if that peril causes a loss, we promise to pay the claim. So we have agreement, consideration. Allow me just to give an example outside of insurance to make sense. I want to buy a house. I make an offer on the house. Is it my house? No. Now the seller agrees. We have offer and acceptance. Agreement satisfied. Do I own the house? No. I have to have consideration, which is closing, right? At consideration, they bring the deed, the keys, and I bring the money. Okay? And if we don't have consideration, it's not a contract. We have to have agreement and consideration. So what about those 2, Peter? These, if they're not present, invalidate the contract. So in other words, if you were high on drugs or alcohol, we can have that contract torn up. You have to be of sound mind. So for example, if you're not capable of holding a job, you have mental disability and you're under the care of your parents, I mean, you could be 30 and have that. You can't sign a contract because it's not going to be valid. You have to be a legal age. You can't be 12 years old. If we have a contract and we find out one of these 3 things is missing, the contract is annulled. It's not existent. Okay? They love to ask on the test, what about a felon? Felon is fine. As long as they're not drunk, they have the mental capacity to enter into a contract and they're legal age, they fit the priorities of a competent party. Okay? The second thing we have to be aware of after the agreement and consideration is the contract itself has to be for a legal purpose. So Rachel Rogers is in this class. I have Rachel sign a contract with me. I want her to drive to a certain part of town and pick up a couple of pounds of cocaine for me. And if she does it, I promise to pay her. She signs a contract, I sign the contract. That's not a contract. You can't have a contract to break the law. So she brings it back. I don't pay her. She can't sue me. It's not a contract. Okay. It has to be legal. All right. She can kill me, but she can't sue me. Okay. So those are 4 elements that are going to be on your test. Agreements got 2 parts, offer and acceptance. Considerations got 2 parts, pay the money, promise to pay the claim. Then you have to be competent. The insured must be competent, and the contract has to be to do something legal. Question, see how we're doing. Which is not an element of a legal contract? No, you can't. Sorry, Rachel. Like I said, you can kill me, but you can't sue me. Which is not an element of a legal contract? So you guys are picking this up. The first 3 clearly are, but the witness to the signature is not an element of the contract. Question, agreement can be in writing or oral, offer and acceptance, promise to pay, or consideration. So you guys picked out right away. It is offer and acceptance. That's what makes up agreement. Another consideration, all are parts of consideration except. Most of you going, you're right. There's nothing in there about a cooling off period. Okay. Consideration, the applicant pays the premium and submits the application. The insurance company makes a promise to pay. Another question, let's see if you guys are keeping up. Who is not a competent party? We have some votes for B, which is the right answer. Now, here's what I want you to remember. If you're on controlled medication prescribed by a doctor, that's okay. If you're on medications that are mind altering, for example, pain pills or something like that, that's going to make you incompetent. Happy hour, you got an alcohol issue. I don't care if you've got a high school degree or not. It has nothing to do with your competency. And a felon also can be competent. Now we're going to get some insurance. That's what I've been doing all morning here. Insurance words. Learn them. Adhesion says the insurer writes the policy and the customer takes it or leave it. Here's the way I think of adhesion. I think of Velcro. Okay? You can't change it. All right? You take it or you leave it. Adhesion, it sticks or it doesn't stick. It's up to you whether you want the policy or not. But adhesion is no bartering, right? It has to be that way. Aleatoire is a word people get messed up on because no one ever uses it in real life, right? It's an unequal exchange. Customer pays a small monthly premium compared to what the insurance company promises to pay if there's a claim. Okay. If you're going to insure that $200,000 home, you're not going to pay $200,000. You might pay $1,000. Okay. Hey, that's a lot of money. It's not 200. If that house burns down, insurance company's got more at stake than you do. And you wouldn't buy insurance if it wasn't that way. Would you buy a policy for $400 that only pays you $400? Of course not. Just keep your money, right? It always offers more than what you pay. And the word for that is aleatory. Melissa, give credit where credit is due. Melissa came up with such a clever idea. She changed the aleatory in her mind to a lottery. In a lottery, I pay $10, but I might get 100 million. Unequal exchange. Okay. Aleatory is an unequal exchange. Personal. You don't have to spend much time on this one. It's always between a customer and the insurance company. It's personal. And the last one is another one that people get messed up on. Unilateral. Let me help you with unilateral. The word uni means one. If you're riding on a unicycle, it's got one wheel. If you have a unibrow, you got one eyebrow right across, right? Uni means one. So what this says is unilateral, only one party is legally bound. What are you talking about, Willis? What I'm saying is, you buy an insurance policy, you're supposed to pay the premiums, and the insurance company is supposed to pay your claims. If you don't pay your premiums, they cannot sue you. You're not legally bound to pay your premiums. Now, if an insurance company doesn't pay a legitimate claim that they said they were going to cover, they can get sued, and they will. Okay. So the insurance company is bound to the contract. The customer is not. And because only one party is bound, we call it one is unilateral. Conditional. Both parties have rules and duties they must follow. I don't think that's very hard to learn. It's like personal. It just kind of makes sense. All insurance contracts are conditional. Who was my friend that had the life insurance policy earlier in the day? Stephen? They're not just going to send Stephen $100,000. There's conditions. Unfortunately, Stephen must pass away. I guess the word we use now, pass. Always thought that was a football term. But anyways, Steve's got to go to the heavenly choir before that money gets paid out. It's based on conditions, right? Reasonable expectations says a customer can expect the coverage if an agent implied, get that word implied, it through during it, though, what's that word mean? I don't know what that word is in there. Implied it during the sale. If an agent says it during the sale, it's right for the customer to expect it. Now, let me just wander off the course for a second. Sometimes customers don't remember what we say, and then they get a price increase because they have a guaranteed renewable policy, which allows the price to increase. And they say, wow, that agent told me my price would never increase. Well, if you said that, you're in trouble. Okay. Now, the insurance company is not going to change the contract, but you might have to make some kind of financial amends to the client. You probably will get fired. What happens is they have to be able to prove that you said it. Okay. And if you do your job correctly, you're going to give them a policy summary that tells them it's guaranteed renewable and rates can go up. Now, if you've done that, they can remember anything they want, but they don't have the evidence. I'm just telling you, if you lie to them, put it in writing, it's reasonable that they would expect that they would get what you told them you would get. Okay? That's what reasonable expectations about. We got to know the difference between representation and a warranty. Okay. Now, I didn't promise you this is going to be the most exciting class you've ever taken, but we got to know this stuff. Okay. A representation is a statement that our client believes is true. They're not being dishonest. I really thought my last ticket was 4 years ago. Well, we check it out and it was 3.5 years ago. Is that a problem? No. I mean, what do you expect? This guy's some sort of memory expert? If it's reasonable, we understand when you put the application down, it's to the best of your knowledge, right? That's a representation. And the insurance company knows it's not guaranteed to be true. I don't want to missell this. If you intentionally put a misrepresentation down and it's important, you commit fraud. But you have to intentionally lie. That's not what we're talking about representation. It's just to the best of my knowledge. Here's the one we always teach in class. Carmen here is the last name I see in it. Carmen fills out an application. Do you have cancer? She says no. Does that mean she doesn't have cancer? No. What it means is she has no evidence anywhere that she has cancer. Truthfully, all of us could have cancer if we haven't been checked out yesterday, but we have no reason to believe we got cancer. So that answer she gave is correct when she says no. She has no evidence. And the insurance company understands that. Okay. If later on we find out that she did have cancer, God forbid, we also find out she had no way of knowing it. She did nothing wrong. She did nothing wrong. She answered it truthfully as she could. That's what a representation is. Now, a warranty is a horse of a different color. I always tried to learn warranty as a guarantee. Okay. This statement must be true. So there are very few insurance questions that must be true, because especially when you're asking about driving record and things like that, health. But what's got to be true? If you're insuring a car, you got to give us the right VIN number, because if you don't, we're going to insure the wrong car, right? If you're going to insure a piece of property, you got to give us the correct address. They have to be true. Elements like that have to be true. But remembering your last speeding ticket and you're a couple months off, that's not a problem. Now, if you can't remember a DUI you had 3 months ago, that's probably a lie. That's probably an intentional misrepresentation, which is fraud, right? But what I want you to do right now is there's a difference between a representation, which is to the best of my knowledge, this is the best I can remember, okay? Versus a warranty, which says absolutely guaranteed to be true. Misrepresentations are an untrue statement. Not all misrepresentations are fraudulent. Like I told you 100 times here, if you don't remember the exact date of your last speeding ticket, that's benign. That's not going to get you in trouble. Concealment is when you're asked for something and you actually lie about it. Have you ever had a speeding ticket? Nope, not me, never had one. And we find out you did. That's concealment. It's information we needed to know and you withheld it from us. So withholding information. Please get this one right, my friends. Fraud requires 2 elements. Water has 2 elements. I'm not a scientist. Hydrogen and oxygen, I'm told, or you don't have water. Fraud must have 2 elements. It must be intentional about a material fact. Intentional means you give an incorrect statement intentionally to deceive the insurance company. So the person who checked they don't have cancer, and they had no way of knowing they had cancer, did nothing wrong. But if we find out prior to filling out the application, they were told they had cancer and they lied about it, that's intentional to deceive. But it must be about something material. Cancer's material. If the insurance company had known it, they would have made a different decision. I'll give you a wild example, stupid wild example. I had my tonsils out when I was 8 years old. Well, that was 100 years ago. The hospital's closed, the doctor's dead. It was no big deal. And they said, have you ever had a surgery? And I just say, I'm not supposed to do this, but I just say, no, concealment. Was I wrong? Yes, I was wrong. But it wasn't material. Okay, I did something wrong, but it's not fraud, because who cares that I had my tonsils out 100 years ago, right? It must be both. intentional and material, to rise to the level of fraud. Well, what's fraud important about? If you commit fraud, the insurance company doesn't have to pay the claim, right? They can invalidate the contract. See how we're doing. An unequal exchange. What's the word for that? I'm going fast because I'm appreciating the fact that you guys have hung in here for a long time with me, longer than the attention span of most people. So I appreciate that. Um, Unequal exchange is a lottery aleatory. An accurate answer on an application. Again, I'm moving along not because I'm impatient, but I'm trying to be sensitive to attention span. It's a misrepresentation. Oh, Peter, why isn't it fraud? It could be benign. It could be something you just didn't have it exactly correct. So it's going to start off as a misrepresentation. To be fraud, it has to be intentional deceit. Right now, it's just misrepresentation. One is bound to the contract. What's the word for that? Uni is always one, unilateral. Another question, characteristic of insurance. Contract is all of these except. Well, what this is, it's conditional, unilateral, and aleatory, but it's not negotiation. In other words, the insurance company comes back and says the rate for you on your homeowner's policy is $700 a year. You can't say, okay, I give you 500 cash today. It doesn't work like that. Okay. So it's not negotiated. Well, for those of you that are concerned that you might spend the rest of your life listening to me, I'm really close to the end. Okay. Two words, waiver and estoppel. When insured signs a waiver, estoppel goes into effect. What does that mean? First of all, with estoppel, remember this, stop. Just stop. You ever had anybody tell you that? Maybe you've had a disagreement with a loved one and you're telling them about how bad they're doing, and they just say, stop. Just stop. Okay. That's estoppel. Okay. You sign a waiver. So I'm going to make up a story. You fly airplanes once a month on Saturdays. The insurance company says, hey, on your life insurance policy, if you want to be covered, you got to pay this extra premium. And you say, no way, I'm not going to pay that. So you sign a waiver where if you die flying that plane, you're not covered. A signed waiver. As soon as you do that, estoppel goes into effect. The family can't sue the insurance company if you died flying a plane. They can't sue because there's an automatic estoppel. You got a form that you signed knowing you weren't covered. So I don't care which attorney you see at 11 o'clock at night, you're going to hire to get that done. It ain't going to work. Okay. Signed waiver produces estoppel. All right, folks, you did it. This is one of my longer classes, but it's so important. So many words. Remember, if you want videos of me or Melissa on life and health or property and casualty, you can rent them for a month by going to YouTube, Insurance Exam Queen, and click on join. So I am really, really appreciative of your participation today. One final thing. If you ever want to contact me directly, this is my personal email. You can take a picture of it. Here's the rules. You can't write to me and say, explain chapter 4. I can't answer that in an email. If it's one question that you need clarification on, I'll be happy to give it a try, see if I can help you. Okay. Um, Sometimes people write to me about specific situations, and I give them the best advice I can. I do tutor people. It's not free, but it seems to work. I'm being, um, what do I want to say? I'm being modest. People write to me all the time that the sessions with me are the things that pushed them over the top. But if you want to know what it costs and everything like that, just ask me. You make the decisions. But anyway, it's been a pleasure for me, and I hope you guys learned some stuff and you got some notes. Um, Thank you for coming. Look for me. I publish my live classes. I should be putting next week's classes up soon. And so you can join in anytime you want. Please go on Insurance Exam Queen. Her website, she is just like a bundle of energy. She's always doing something new and exciting on her website. So go there and see how we can help you. Thank you for coming. It was a pleasure for me, and I hope you guys benefited from it. And if you want to write to me, you tell me, Peter, I liked your class, but please wear a different shirt next time. Something, whatever you want. Okay? All right. You guys have a great day.